The myth versus math showdown. Who wins? Neuro AI is dropping in right now to give you the one answer you've been looking for. This is the myth versus math showdown, the main event, the big fight. On one side, we have real estate, the king of tangible assets, the thing you can touch and feel. On the other side, we have stocks, the engine of the global economy, the digital shares that build empires. Everyone has an opinion. Your uncle swears by his rental properties. Your cousin just made a killing on some tech stock. But opinions don't pay the bills. We are here to cut through all that noise, all that chatter. We are going to use plain words and simple numbers to figure this out once and for all. Which one actually makes you richer? This isn't about fancy theories or complicated charts. This is about real-world results. Myth versus math. And a 6-minute verdict from Neuro AI. Let's get into it. The clock is ticking. So many people are absolutely convinced that real estate is the only real way to get rich. It's a belief passed down through generations. They tell you to buy a house, find someone to rent it out to, and then just sit back and watch the money roll in. It sounds so simple, so perfect. They love the idea of owning a piece of the earth, something solid you can point to and say, "That's mine." They talk about the power of rental income, that magical phrase, passive income, appealing to our desire for security and control. You buy a property, the tenant's rent covers your mortgage and leaves a little extra. Meanwhile, the property keeps rising in value. Year after year, your net worth climbs. Then you sell for a massive profit and retire to a beach somewhere. But the story often skips the struggles, the leaky roofs, tenants who stop paying, and the property taxes that keep rising. Myth number 1. Houses always go up in value. This is one of the most dangerous myths. Bought at the peak in 2007, right before the crash in 2008. Down 20%, 30, even 40. Real estate prices can and do fall. A lot depends on the local economy, interest rates, and the broader housing market. Location is everything. A house in a dying town won't appreciate. Myth number 2. Rental income is easy, passive money. Being a landlord is a job. Tenants can be great, or a nightmare. Yes, they will call at 2 a.m. because a toilet is clogged. They might miss rent for months, leading to costly evictions. New roof, $10,000. New furnace, $5,000. Hire management if you want. It'll cost 8 to 10% of rent. Easy money? Not so fast. Myth number 3. Real estate always beats the stock market. Let's break it down with some simple numbers. Price, $200,000. Down payment, 20%, $40,000. Loan, $160,000. Mortgage, about $900 per month. Taxes and insurance, $200. Rent, $1,400. Costs so far, $1,100. Looks like $300 left. Set aside 10% of rent for repairs, $140. Management 10%, $140. Together, $200. $1,400 minus $1,100 minus $200 equals $100 per month. That's $1,200 a year. Now let's flip the coin and talk about stocks. Simplicity, liquidity, and compound growth. Indexes like the S&P 500 represent the largest companies in the U.S., historically around 7 to 10% per year over the long run. Open an account in minutes and buy broad, low-cost index funds. Start small, even with fractional shares. No tenants, no toilets, no termites. Need cash, sell, and have money in days. Myth: stocks are gambling. The math says otherwise. You own productive businesses. Diversify and participate in economic growth. Myth: you need lots of money. Not today. No minimums and fractional shares. Myth: stocks always beat real estate. There is no always. Some decades were flat for stocks while certain cities boomed. Winners diversify, avoid timing, and stay the course. Same $40,000 goes into a low-cost S&P 500 index fund. At 8%, after a year, you're at $43,200. That's $3,200 in growth. Dividend yield at 1% adds about $400. Total $3,600, roughly 9%. No debt, almost zero effort. On paper, real estate wins year one because of leverage, but leverage cuts both ways. If price drops 5%, that's a $10,000 paper loss. Leverage adds risk. Stocks use no debt and remain hands-off. The better choice depends on your tolerance for risk, work, and complexity. The honest answer: there is no single winner for everyone. The best investment fits your personality, finances, and goals. Real estate can make you richer faster if you've got skill, work ethic, and debt tolerance. Find deals, Manage well, use leverage wisely. The upside can beat stocks. If you're busy and want simplicity, stocks are likely your path. Automate, diversify, and let compounding work. Many wealthy people don't choose, they blend both. Rule 1. Start now. Time is the most powerful ingredient. Every day you wait is compounding, you don't get back. Rule 2. Diversify. Don't put all your eggs in one basket. Spread properties across areas. Own broad market funds. Rule 3. Keep costs low. Fees are silent killers. Choose low-cost index funds and be ruthless on real estate expenses. Rule 4. Think long-term and control your emotions. Don't panic sell. Buy and hold quality assets through storms. Create a plan. Stick to it. Tune out the noise. This was Neuro Profit AI with the Myth versus Math Showdown. The right tool is the one that fits the job you need to do. Pick the path that matches your life, follow these rules, and get started. Good luck from Neuro Profit AI.